Right now, we've got Western tech giants basically dropping $1 trillion to try and build this unbreakable AI monopoly.
Yeah, a literal trillion.
Right, $1 trillion. But halfway across the world, there's a scrappy team of engineers who just figured out how to replicate that exact same intelligence for, essentially the cost of a luxury apartment.
Which is just a rounding error for these big companies.
Exactly. Welcome to today's Deep Dive. We are super thrilled you're joining us. I'm your host, and I'm here with our resident tech and economics expert.
Hey everyone, glad to be here for this one.
So if you've been watching the tech space lately, you know we're in the middle of what feels like this unstoppable gold rush, right?
Oh, absolutely. Total frenzy.
But today, we're doing something a bit different. We're going to look at some really fascinating structural analysis of this global AI boom that we've gathered from a few deep dive sources.
And we are asking a very uncomfortable question today.
Yeah. What happens if the gold everyone is rushing for is suddenly everywhere and practically free?
It is honestly the ultimate paradox in the global economy right now, and I do want to set the tone immediately for you as we get into this.
Right, let's manage expectations.
Yeah. We are not here today to predict some cataclysmic tech crash.
No doom-mongering.
Exactly. And we're also not here to confirm that, artificial general intelligence is going to arrive next Tuesday and solve all of humanity's problems.
As much as it might want it to.
Right. What we're doing today is mapping the pressure points. We're looking at this massive system of global forces, financial, physical, geopolitical, that are all just sort of stacked on top of each other.
We're looking for the fault lines in what is basically a multi-trillion-dollar global bet.
A very precarious bet.
Because when you look at the sources we are exploring today, they highlight this massive contradiction between how the West is building AI and how the East is building it.
It's a tale of two entirely different philosophies.
Yeah. In the West, we are seeing infrastructure spending that just completely boggles the mind. We're talking hundreds of billions of dollars.
Yeah. And over the next few years, arguably approaching that $1 trillion mark we mentioned.
And all of that spending, all of that concrete and silicon and copper, it's all based on one fundamental idea.
Right. The idea that frontier technology, meaning the absolute cutting edge of artificial intelligence, is incredibly scarce and incredibly expensive to create.
Which leads to this assumption that whoever has the money to build it gets to charge a massive premium for it. Like, they own the toll booth on the highway of the future.
That's the business model in a nutshell. But meanwhile, on the other side of the globe, the East is demonstrating something entirely different.
Completely flipping the script.
Yeah. They're showing that frontier-adjacent AI, so models that are nearly as good as the absolute best Western models, can be achieved at just a mere fraction of the cost.
Okay, let's unpack this, because honestly, calling the Western model a sunk cost almost feels like a wild understatement.
It's an empire-building exercise at this point.
Totally. We hear these numbers thrown around, 50 billion here, 100 billion there. But what does that actually look like on the ground?
Right.
Where is this money physically going?
So to understand the sheer scale, we have to talk about the hyperscalers.
The big guys.
Right. When we use that term hyperscaler, we're essentially talking about the massive landlords of the internet, the companies that own the cloud.
So companies that rent out computing power and storage to other businesses.
Yeah.
Amazon, Google, Microsoft, those kinds of players.
Precisely. They have these massive data centers, and their capital expenditures right now, what they're spending to build and upgrade, are historically unprecedented.
Just off the charts.
Yeah. They are buying advanced GPUs, graphics processing units, by the truckload, specifically chips like NVIDIA's H100s and H200s.
Let's actually define what those are for a second, because they are really at the center of everything. An H100 isn't like the chip in your everyday laptop, right?
Oh, not at all. Think of the CPU in your laptop like a very smart executive who can do one really complex task at a time very quickly.
Okay, it makes sense.
But a GPU, like the H100, is more like a massive factory floor of thousands of workers who can all do simple math at the exact same time.
Wow. Okay.
And AI training requires doing billions of simple mathematical equations simultaneously. So these H100 chips are basically the ultimate specialized brain tissue for AI.
And they are not cheap.
No. They cost roughly $30,000 to $40,000 a piece.
A piece. And these hyperscalers are buying them in what, batches of 100,000?
Exactly. Whole fleets of them. So you take the hyperscaler spending, and then you add in the massive venture capital rounds going to the top AI labs.
Right.
You add the sovereign wealth funds pouring money in. And crucially, you add the physical energy infrastructure being bolted onto the power grid just to run all these chips.
It's just an astronomical amount of capital.
You are rapidly approaching $1 trillion commitment.
What really fascinates me is the psychology behind this. Because,
Yeah.
these companies have some of the smartest financial minds on Earth.
They absolutely do.
They don't just light money on fire for fun. So why the frenzy? The sources point to a really deep psychological driver here, which is basically existential fear.
It is entirely the fear of obsolescence.
Right.
There's this deeply held perception in these boardrooms that AI is not just a feature you add to software, it's a general-purpose technology.
Like electricity.
Exactly. Like electricity or the internal combustion engine or the internet itself. If you miss the transition to electricity, your factory goes out of business.
You're just done.
Yeah. So the perceived cost of falling behind in AI is absolute zero. You die as a company. In their minds, not spending $100 billion feels infinitely more dangerous than spending it.
They're trapped in a race where the only losing move is just not playing aggressively enough.
Right. But that creates some truly brutal arithmetic for the stock market because eventually all of that spending has to translate into actual profit.
Otherwise, the shareholders are going to completely revolt.
Exactly. Their entire valuation, their massive corporate debt structures, their multi-year energy contracts, it all relies on a single load-bearing assumption.
And that assumption is scarcity.
Yes. They are assuming a durable technological moat based on sheer capital expenditure.
Like, we spent $80 billion building the biggest data centers on Earth. Therefore, no one else can compete with us.
Right. And they assume they will capture trillions of dollars in enterprise value by charging incredibly high prices for access to this intelligence.
Because they spent the most, so they win the most. One of the sources uses this great analogy. It's like they built this incredibly expensive, intricate, majestic cathedral.
I love that analogy.
Yeah. They imported the best stone. They hired the top architects. They spent years just on the stained glass. And their whole business model is to charge a steep admission to this cathedral for the next century.
That is the Western strategy in a nutshell.
Yeah.
Build the biggest cathedral.
But then we look at the Eastern model. And the structural path there completely upends this logic.
It really does. In China primarily, but also with some players in the Gulf states, the capital is just diffused differently.
How so?
Well, it's not just concentrated in a handful of massive hyperscalers like we see here. You see state-guided capital, you see a deep integration with university pipelines, and you see a very competitive, scrappy ecosystem of independent AI labs.
We're talking about groups like DeepSeek, Quinn, Zipu, and Moonshot, right?
Exactly. Those are the big ones making waves.
And what these labs have done, particularly when you look at what DeepSeek did with their R1 model and Quinn's trajectory over the last year, is they basically figured out how to 3D print a highly functional chapel in a weekend for pennies.
What's fascinating here is that they proved you don't need the cathedral to get people to come pray, so to speak.
But wait, I have to push back here a little bit.
Sure, go ahead.
Isn't the East just drafting off the West's massive R&D budget?
Yeah.
I mean, you can't 3D print a chapel if someone hasn't spent the billions to invent the 3D printer first.
That's a very common argument, yeah.
Are they actually innovating, or are they just highly efficient fast followers using the foundation that the West paid to lay?
That is a phenomenal question, and it's really central to this open exploration we're doing today. For a long time, the Western assumption was exactly what you just said.
They're just copying us.
Right, they're just copying us, and they will always be a generation behind. But the structural analysis we're looking at suggests something much deeper is happening.
Okay.
It's not just copying, it's a fundamental divergence in how they actually achieve the intelligence.
Break that down for us. Because the claim from the sources is that they are reaching frontier-adjacent capability, meaning they are right on the heels of the best Western models at a fraction of the cost.
A tiny fraction.
So how is that mechanically possible? Did the massive H100 chips magically get cheaper in Beijing?
No, in fact, it's the opposite. Because of Western export controls, the chips they actually have access to are often older, less capable, and more expensive on the black market.
Oh, wow. So they're at a hardware disadvantage.
A massive one. The cost reduction actually comes from algorithmic innovation. Let me give you a specific example of how this works mechanically. Have you heard of a mixture of experts architecture, or MOE?
I've heard the term thrown around, but what is that exactly?
So in the early days of these massive Western models, they were what we call dense. When you ask the model a question, every single parameter, every single artificial neuron in that massive digital brain fired up to process your prompt.
That sounds exhausting for a computer.
It requires an immense amount of computing power to generate an answer.
It's like trying to learn a language by reading the entire dictionary from A to Z every single time you want to speak a single sentence.
That is the perfect way to put it. It works, absolutely, but it is wildly inefficient. What the Eastern labs, and to be fair, some open source labs in the West too, really leaned into is this mixture of experts concept.
Okay, so how does the dictionary work in this version?
Instead of firing up the whole brain, the model is divided into subnetworks. These are the experts. If you ask a coding question, a router in the software sends your prompt only to the coding expert.
Ah, I see.
If you ask for a poem, it routes it over to the creative writing expert.
So you aren't activating the whole dictionary. You're just accessing the specific grammar rules you need at that exact millisecond.
Right, and they combine this architecture with extreme data efficiency. They aren't just scraping the whole chaotic internet and throwing it into a blender hoping for the best.
We're being picky.
Very picky. They are generating high-quality synthetic data to train the models much faster. And they're using techniques like quantization.
Quantization?
Yeah, it essentially means doing the complex math with fewer decimal places to save memory without actually losing much accuracy.
So they are achieving, say, 95% of the intelligence, but they are doing it using a completely different, vastly more efficient blueprint.
Which completely shatters the Western narrative.
Right.
The whole narrative was, you need $100 billion and a small nuclear reactor to compete in this space. And the East just proved that, well, you might actually only need a few $1 million and some really clever math.
And this brings us to what the sources call the commoditisation trap.
Yes, priority one.
If someone can replicate your capability and their cost to actually run the model, what we call inference costs.
Right, the cost per query.
If that cost is 5 to 20 times lower, what happens to your $4 trillion market cap built on the idea that you have a monopoly?
That is the ultimate pressure point we're mapping today. Is a durable technological moat even possible in software anymore?
It's a scary question for these investors.
When the underlying mathematics can just be published, reverse engineered, or open sourced, how do you defend a $100 billion infrastructure investment? You are trying to put a toll booth on a road, and someone else just figured out how to pave a highway for free right next to you.
It's wild. So we've established that the software margins might collapse. The moat is definitely vulnerable. But how does that actually translate into a crisis?
Because right now, the stocks are still high.
Right. How does a cheap 3D printed chapel in the East genuinely threaten the massive cathedral in the West? Let's track exactly how that threat could trigger a financial chain reaction. We need to look at the financial transmission mechanism.
Which the sources describe as being causally stacked.
Causally stacked. That's a great phrase.
It's vital to understand. It means the financial structure of this entire AI boom isn't a bunch of strong, independent pillars holding up a roof. It is a single, towering house of cards.
A pile of dependencies.
Exactly. If you pull out the wrong block at the bottom, the whole thing just shudders and comes down.
So if I'm, say, Microsoft or Google, and I'm handing billions to NVIDIA for these chips, where exactly does the return on that investment get bottlenecked?
Let's trace it. Let's walk the chain.
Yeah, trace the circularity of this capital pile for us. Where does the money start and where does it get stuck?
Okay, step one, NVIDIA. They are selling the picks and shovels for the gold rush. Their revenue right now is astronomical, but it is incredibly concentrated.
Meaning they don't have that many customers.
Right. The vast majority of their sales rely on just 5 to 7 massive hyperscaler customers.
So if those 5 companies sneeze, NVIDIA catches a cold.
A severe cold, maybe pneumonia.
Wow. Okay, so that's step one.
Step two. Why are those 5 hyperscalers buying all those chips? They are justifying this massive capital expenditure, often called CapEx in the finance world, based on projected future AI revenue.
They have to promise Wall Street something.
Exactly. They are telling Wall Street, yes, we are spending $50 billion this year, but don't worry, it will result in $100 billion in new recurring revenue down the line.
And step 3 is where the rubber meets the road.
Right. Step 3, what does that projected AI revenue actually rely on? Because it doesn't just magically appear. It relies on mass enterprise and consumer adoption at premium prices.
They need regular businesses paying for this.
They need Fortune 500 companies paying hefty monthly subscription fees for AI integration in their offices. They need to charge high API pricing.
Let's define API pricing for the listener real quick, because this is the actual mechanism of how they plan to make money.
Good idea. API stands for Application Programming Interface. In simple terms, it's a digital tool booth.
Okay.
If a company wants to build, say, a customer service chatbot for their website, they don't have the resources to build their own AI from scratch. So they plug their software into the hyperscaler's AI via an API.
So they rent the brain.
Yes. And every time a customer asks that chatbot a question, the hyperscaler charges a fraction of a cent.
It's literally a toll road for digital thoughts.
Exactly. And the hyperscalers need millions of companies paying tolls on their roads all day, every day to pay off the data centers they just built.
That makes total sense. But then we hit step 4, which is basically the wrecking ball.
Cheaper alternatives arrive on the scene.
Right. If those efficient Eastern models, or even open weight models released by researchers in the West, are suddenly available, the enterprise calculation completely changes.
Overnight. Think about it. If a bank or a massive logistics company realizes they can get 90% of the AI capability they need for a tiny fraction of the cost, they aren't going to pay the hyperscaler's premium API tool.
Why would they? And if they don't pay the toll, the adoption revenue disappoints. Wall Street sees the numbers, and the hyperscaler misses their earnings target.
And if the revenue disappoints, what happens next? The hyperscaler's board of directors is going to step in and say, whoa, we need to cut our capital expenditure guidance. We need to stop buying so many chips.
Which instantly loops back to step 1, NVIDIA's revenue drops.
It's a closed loop.
And when a closed loop starts spinning in reverse, things get really ugly really fast. The sources point out just how highly leveraged this whole build-out is.
Yes, the leverage is key here.
And I want to be super clear here, because when people hear words like leverage and financial contagion, they immediately think of 2008. They think of subprime mortgages and the global banking system collapsing, people losing their homes.
Right, and it's important to differentiate. We are not saying this is 2008. The banks aren't holding toxic consumer mortgages this time. But the system is deeply leveraged in the corporate sense.
The domino effect.
Exactly. If hyperscaler CapEx guidance drops by, say, 20 to 30%, the shock propagates instantly through the corporate world.
First, it hits the semiconductor supply chains, the companies making the parts for the chips. But then, importantly, it bleeds into the physical world.
This is where it gets very real for average investors. It hits the commercial real estate market specifically, data center REITs.
A REIT, Real Estate Investment Trust. Let's explain this mechanism, because this is exactly how everyday retirement accounts and pension funds get tied up in this tech boom.
So a REIT is a company that owns, operates, or finances income-generating real estate. Normally, you think of shopping malls or massive apartment buildings.
Right, brick and mortar stuff.
And everyday investors can buy stock in a REIT, and the REIT pays them regular dividends from the rent they collect from the stores or the tenants.
But in this case, instead of shopping malls, these specific tech REITs are pooling billions of dollars to pour concrete, build massive warehouses out in the desert, and install industrial air conditioning for server farms.
Exactly. And they borrow heavily to build these structures, assuming, based on that CapEx guidance, that the hyperscalers will sign 15-year leases to rent them out.
But if the hyperscalers suddenly pause their expansion,
then those data center REITs are left holding massive debt on essentially empty concrete shells.
right.
And then the contagion spreads. It hits the private credit funds that lent them the money to build the shells. And finally, it hits the broader equity indices because AI-related names now make up an enormous percentage of the S&P 500.
Reading this analysis, it immediately brought to mind the late 90s.
Oh, the dot-com bubble.
Specifically, the sources make a direct and frankly fascinating comparison to the 1998 to 2001 telecom fiber buildout.
Yes.
And I think we have to spend some time here, because the historical parallels are just eerie. Think about that era. You had companies like Global Crossing and WorldCom laying millions of miles of fiber optic glass in the ground and across the ocean floor.
And why were they doing it at such a frantic pace?
Pure competitive fear.
Mm-hmm.
The narrative at the time was that internet traffic was doubling every 100 days.
Right, the infinite growth metric.
Exactly. So the thinking was, if you didn't lay the dark fiber immediately, you'd be locked out of the new digital economy forever. They skipped the rigorous ROI return on investment analysis because the strategic FOMO was just too high.
But wait, let me play devil's advocate to your analogy for a second.
Go for it.
The telecom companies were actually right about the future, weren't they? I mean, we did eventually need all that bandwidth. We got YouTube, we got Netflix, we got massive cloud computing. The fiber was incredibly useful.
Oh, they were absolutely right about the technology. The internet was exactly the world-changing force they thought it would be. The fiber was essential. But they were completely wrong about the timeline, and they were catastrophically wrong about the pricing.
Ah, because of the overcapacity?
Yes. Because everybody laid fiber at the exact same time out of fear, they created a massive glut.
And what happens when there's an oversupply of commodity?
The price collapses.
Yeah.
Bandwidth prices just fell through the floor. So even though the technology worked perfectly, the shareholders who actually funded the build-out got completely wiped out.
The timing is everything.
Right. The companies went bankrupt, they restructured, and the fiber stayed in the ground for someone else to buy for pennies on the dollar years later. So the open question we really have to ask ourselves right now, looking at this AI infrastructure build-out.
Where are we in the cycle?
It's exactly. Are we in 1999 where we have 3 more years of irrational exuberance and stock market highs before the reckoning? Or are we in late 2000 where the overcapacity is already baked into the system and the reckoning is beginning right now?
That is the multi-trillion-dollar question. And what keeps this exploration open, what makes it so incredibly unpredictable, is the realization that right now, nobody in the industry is doing cold, calculated, net present value math.
It's all vibes and strategy.
Truly, the marginal buyer of an H100 chip is not opening up an Excel spreadsheet and calculating exactly when it will pay for itself. It is all still driven by strategic fear.
The mindset is just, if I don't build it, my competitor will, and I lose the platform shift.
And that strategic logic works perfectly fine.
Yeah.
Right up until the exact moment it doesn't.
Which is terrifying. What happens the moment the music stops? What is the trigger for that?
The vulnerability here is consensus. It's a psychological game. What happens the exact moment one major player blinks?
Right.
Imagine one CEO on an earnings call says, you know what, actually, our enterprise AI revenue isn't scaling quite as fast as our infrastructure spending. We are going to cut our CapEx guidance for the next 2 quarters just to digest what we've already built.
Just a slight pause.
Just a pause. But the moment that happens, the idea that everyone is spending, so it must be rational, evaporates overnight. The illusion breaks.
And that is exactly how the financial contagion is triggered.
Precisely.
Okay, so we've explored the financial house of cards. But let's dig deeper into the why of it all. Why would the adoption revenues fail in the first place? Why wouldn't massive enterprises just happily pay the premium for the absolute smartest, most advanced AI available?
Because intuitively, you'd think they'd want the best.
Right. We need to talk about the unexpected speed of cost asymmetry. We're talking about the collapse of the intelligence premium.
This is where the engineering reality collides violently with the business models. The West assumed that frontier AI is fundamentally hard, expensive, and slow to replicate.
They thought they had time.
Yes. But the math is changing radically. We discussed the architectural innovations earlier, like the mixture of experts. Because of those breakthroughs, we are moving from a world where training a competitive model costs $500 million to a world where you can train a highly competitive model for maybe $5 to $10 million.
But wait, why wouldn't a Fortune 500 enterprise still want the absolute best? I mean, if the Western model scores 98% on some complex benchmark and the cheaper Eastern or open source model scores 92%, if I'm a major global bank, don't I want the 98%?
It seems logical.
Why wouldn't I just pay the premium to be safe?
It's a question of diminishing returns and actual practical use cases. Let's look at the power of open-weight diffusion. First, we should probably explain what open weight actually means because it's crucial here.
Good call, because we hear open source all the time, but open weight is slightly different in this context.
Right. Think of it like a restaurant. Open source is like publishing the exact recipe, the list of ingredients, and the oven temperature so anyone can go home and bake the cake themselves.
But you still have to buy the ingredients.
Exactly. Baking an AI cake from scratch, even with the recipes, still requires thousands of GPUs and millions of dollars of electricity. Open weight, on the other hand, is like giving away the fully baked cake for free.
Wow. Just handing it over.
Yes. The weights are the mathematically trained parameters. It's the actual intelligence the model learned after digesting all that data for months.
So they just take the fully trained digital brain, they put it on a platform like Hugging Face, and anyone can literally just click download.
Exactly. And this presents a massive existential dilemma for the hyperscalers. Imagine a Western enterprise customer, say, a massive logistics company looking to automate their supply chain routing.
Okay.
They are looking at two options. Option A, pay a hyperscaler a premium API fee every single time their system makes a routing decision. And by the way, this locks them into that specific hyperscaler's cloud ecosystem forever.
Right, vendor lock-in. And option B.
Option B, download an open-weight model for free. Run it locally on their own private servers, which, by the way, protects all their highly proprietary data from leaking.
Security is huge for these companies.
Huge. They fine-tune that free model specifically for their own logistics data, and they pay $0 per API call going forward.
And this brings us back to your point about diminishing returns, the good enough threshold. Because, sure, maybe the proprietary Western model is objectively better at writing Shakespearean sonnets or solving abstract quantum physics problems.
But most economic activity isn't quantum physics.
Exactly. The vast majority of real-world economic applications, classifying legal documents, extracting data from medical intake forms, generating basic Python code, running a customer service chatbot. You do not need the absolute frontier intelligence for that.
No, it's overkill.
You just need reliable, fast, cheap pattern recognition.
If an open model is 90% as capable as the proprietary model, but it costs 5% of the price to run, that 90% capability is going to capture almost all the market volume.
It's just simple economics.
The extra 8% of intelligence is simply not worth a 20x multiplier in cost and the pain of being locked into one vendor.
And if we project this dynamic forward, the sources suggest we start to envision a bifurcated AI economy, a completely split world. Paint that picture for us. What does that split practically look like?
Well, on one side of the split, you have the top 10% premium tier. This will likely still be captured by the massive Western labs. These are the high liability applications. Think about pharmaceutical drug discovery, national defense systems, complex medical diagnostics, or autonomous driving.
Basically areas where if the AI hallucinates or makes a mistake, someone dies or billions of dollars are instantly lost.
Exactly. In those fields, you need absolute cutting-edge reasoning, sure. But more importantly, you need accountability and indemnification.
You need someone to sue.
You need a $2 trillion company standing behind the model so you can sue them if things go horribly wrong. That premium tier is very real, and it is highly valuable.
But it's smaller than the hype suggests.
Much, much smaller than the AI will consume everything narrative assumed. Because on the other side of the split, you have the commodity tier. This is the other 90% of the market.
The day-to-day stuff.
Yeah. This is the global south, the east, and just everyday businesses in the west running derivatives of open models on modest, affordable hardware. They are doing the daily grind of the global economy, inventory management, translation, basic administration.
Here is where it gets really interesting, and this is a question I want to throw out to you listening. We've been sold this trillion-dollar AI narrative by the companies building the infrastructure. But let's just follow the logic for a second.
Okay.
If the commodity tier, the 90% of mundane use cases running on cheap, open models is what creates the most actual economic value globally. But that value is not captured by the companies who spent billions building the massive data centers. Who actually wins?
It's the classic innovator's dilemma, but it's happening on a macroeconomic scale.
Right.
The value might accrue entirely to the users of the technology, rather than the creators of the infrastructure. Think about the millions of small businesses worldwide who suddenly have access to free, highly capable intelligence.
Their margins go up, their productivity just soars.
Which means the people who built the cathedral don't get the tithing. The congregants just walk out and use the knowledge for free in their own backyards.
That is wild. Okay, so far we've talked a lot about balance sheets, software valuations, architecture, and API pricing.
A lot of digital concepts.
Yeah. And the thing about software and stocks is that they can change quickly. A stock price can plummet in an afternoon. Software can be open sourced with a single click. But we have to transition now to the physical world.
This is where it gets heavy.
Literally. We have to talk about concrete, power grids, and irreversible lock-in. Because you can't just delete a physical data center the way you delete a line of code. Let's look at what happens to all that concrete and steel.
This is where the structural problem becomes completely immovable. You can write down a software valuation on a spreadsheet. You can restructure a corporate bond in bankruptcy court. But you cannot unpour 50,000 tons of concrete.
You can't undo a building.
No, you cannot unlay a high-voltage transmission line across a mountain range, and you cannot easily unsite a massive natural gas turbine.
And the scale of the physical infrastructure being built for this AI boom is, frankly, hard to even wrap your head around. It's not just a few warehouses sitting in Silicon Valley.
No, the staggering physical requirements are the anchor that could drag this whole dynamic down. Let's look at the U.S. power grid alone as an example. Projections indicate a need for 30 to 50 gigawatts or maybe even more of new data center power demand by 2030.
Just to give a sense of scale for the listener, what does 1 gigawatt actually look like?
1 gigawatt is roughly the capacity of a large nuclear reactor. Or if you want to think about it in human terms, it can power about 750,000 homes.
Okay, so we are basically talking about adding the power equivalent of 30 to 50 entire nuclear reactors to the grid, just for data centers, in the next 5 to 7 years.
Yes.
So basically, we're going to have to power the entire state of Ohio just so I can generate a picture of a cat riding a skateboard in 4K.
I mean, it sounds absurd when you put it like that, but structurally, yes, that is the baseline load they are asking the utilities for. And when you build energy infrastructure at that scale, you don't just plug it into a wall outlet and hope it works.
It takes years of planning.
Decades. You are locking in natural gas pipelines, nuclear capacity, and massive solar arrays for 25 to 40 years. These are generational physical investments, and they're financed by municipal bonds, utility rate bases, and highly complex power purchase agreements.
So let's connect the causal stack again. Let's go back to our earlier premise. What happens if the adoption revenue disappoints because the open weight models completely commoditize the market?
The hyperscalers pull back their spending.
Right. But we have these massive data centers sitting there, half-built or newly operational. They don't just vanish into the ether.
No, they don't vanish. They have to be repurposed. The investors who own the concrete have to try and recoup their money somehow. But the economics of repurposing are brutal.
Walk us through that math.
Imagine a massive, state-of-the-art AI data center. It has highly specialized liquid cooling systems for the GPUs. It was financed and built on the expectation that it would generate, say, $2 per watt, running high-premium AI inference tasks for big banks.
Okay, so the whole business model requires $2 per watt to pay back the massive construction loans.
Right. But if the premium AI market collapses because of open models, that data center has to fall back on running whatever else it can find to keep the lights on.
Like what?
Commodity cloud storage, video rendering for streaming services, or maybe even pivoting back to crypto mining.
And what do those commodity tasks actually pay?
Maybe 15 cents a watt.
Ouch. So you build a state-of-the-art factory expecting to manufacture and sell Ferraris with a Ferrari-sized loan, and you end up having to manufacture unicycles just to keep the lights on.
The math physically does not work. The debt simply cannot be serviced at 15 cents a watt.
And here's where the political economy becomes a major factor, which actually slows down the whole reckoning, right?
No, absolutely. This isn't just a pure frictionless market correction where a tech company goes bankrupt, the stock drops on an app, and we all move on with our lives.
Because it's physical.
These data centers exist in physical space. They are located in specific congressional districts. They employed thousands of union construction workers to build, and they employ local operations staff to run them day to day.
It's the local economy.
The utilities that built the power generation capacity have everyday citizens as ratepayers. The natural gas suppliers have ironclad 20-year contracts.
So there is a massive, localized physical constituency that needs this build-out to continue, regardless of whether the underlying financial logic still holds up.
Because they have jobs on the line.
Right. The local mayor doesn't care about API pricing in Silicon Valley. They care about the property taxes the data center pays to fund the local schools.
Exactly. The political pressure to keep these projects afloat, to subsidize them or bail them out at the state or federal level will be immense. The distortion in the market will linger for years simply because politicians and local governments cannot afford for these massive infrastructure projects to become stranded assets overnight.
It would devastate local municipal budgets.
Entire towns could go bankrupt.
This leads me to a really wild extension that the sources touch on. And it's a completely different angle I want to explore with you.
Okay, let's hear it.
Let's play this out globally. The West overbuilds this incredibly expensive energy infrastructure, demanding, as we said, 50 new nuclear plants worth of power. Meanwhile, the East is running highly efficient models on modest hardware, so they aren't drawing the same massive power loads.
Right, they're being lean.
If the West forces this massive artificial energy demand onto its grid, do we inadvertently saddle our entire broader economy with higher baseline energy costs?
It is a very real, very systemic risk. Think about how utilities work. When utilities spend billions to upgrade the grid for a massive new client, like a data center, those costs often get socialized.
Meaning everyone pays for it.
Exactly. They get passed down to the everyday ratepayer through the utility commission.
Right. So suddenly, a traditional steel manufacturing plant in Pennsylvania is paying 20% more for electricity just to subsidize the AI boom. Residential homes are paying more to run their air conditioning in the summer. The whole industrial base becomes more expensive to operate.
While the competitor abroad, who isn't straining their grid with brute force AI training, is running leaner and enjoying cheaper power.
Exactly. So does the pursuit of this specific type of brute force AI leadership actually erode our broader industrial competitiveness?
It's a terrifying paradox.
We build the most advanced AI in the world to try and win the economic race, but the sheer power bill to run it bankrupts our traditional industries.
It is the unintended consequence of prioritizing massive scale over efficiency. And this structural tension in the physical world transitions us perfectly into the next layer of this analysis.
Because it's not just about wires and concrete.
No, because the physical and financial fallout is only half the story. We must examine the human feedback loop. We have to ask, how are labor markets and the geopolitical narratives we tell ourselves going to react to this disruption?
Let's get into the human toll and what the sources fascinatingly call the Sputnik deflation.
I love that term.
Let's start with the labor markets and the broken social contract. Because the story we've been told, the story sold to voters across the West to justify all this disruption and all these tax breaks, is the AI prosperity dividend.
Right, the narrative is incredibly optimistic.
Utopian, almost.
It goes like this. AI will make everyone more productive. It will take away the drudgery of your daily work. It will grow the overall economic pie so massively that those gains will be broadly shared among everyone.
It is the promise of the AI-augmented worker. You know the saying. You won't lose your job to AI, you lose your job to a human using AI.
That's the catchphrase they use at every tech conference.
Yeah.
But the structural analysis we are looking at paints a very different and much darker likely reality.
Yeah.
It asks us to look at the actual mechanism of value creation.
The disconnect between the promise and the structural reality is just profound, because what is economically more likely to happen is severe wage compression for cognitive labor.
The AI-augmented worker story might be true for a very thin, elite layer of highly skilled professionals. You know, the top 1% of coders who can leverage AI to do the work of 10 people.
But what about the rest? Let's ground this. Walk me through a day in the life. Take a junior legal associate or a supply chain analyst or a copywriter.
The white-collar middle class.
Exactly. How does an open-weight model commoditize them?
Let's take the junior legal associate as an example. Historically, their value to a major law firm was their ability to spend 60 grueling hours a week reading hundreds of dense contracts, synthesizing the clauses, and flagging any legal anomalies.
Basically being a human search and reasoning engine.
Yes. They were paid a premium salary for that cognitive endurance.
I don't know.
Now, a senior partner at the firm can just take an open-weight model, fine-tune it on the firm's historical case law over the weekend, and run it locally on a secure server.
And what does that mean for the associate?
Well, that model can read 10,000 contracts in 3 minutes and flag the exact same anomalies. The AI doesn't completely replace the need for lawyers, of course, but it instantly commoditizes the tasks that justified the junior associate's high salary in the first place.
So they don't get fired, but they don't get paid what they used to.
The AI doesn't augment them. It turns their specific skill into a cheap commodity.
So the value of their labor drops. But, and this is the key point, the productivity is still happening.
Oh, the work is getting done.
The contracts are getting reviewed. The work is getting done faster than ever. So where does the capital from that productivity go? If the junior associate isn't getting paid for it, who is?
The capital flows upward. It flows relentlessly to a very small set of infrastructure owners, platform monopolists, and in this case, the equity partners at the top of the firm.
It trickles up, not down.
The capital that was supposed to flow to the middle class as a broad prosperity dividend is instead captured by the people who own the compute and the model weights.
And this brings up what I see as a massive paradox, the paradox of democratization. Because on a global scale, cheap AI is incredibly empowering.
That's revolutionary.
If you were a small firm in the global south, say a logistics startup in Lagos or a design agency in Jakarta, you suddenly have access to world-class intelligence for pennies. You don't have to hire a massive Western consulting firm that is inherently democratizing.
It is a massive leveling of the global playing field. Right. But
it rapidly erodes the Western knowledge worker's premium. For decades, a significant part of the Western middle-class economic advantage was based on having exclusive access to expensive tools, elite university networks, and deep institutional knowledge.
It was a moat.
Right. But if the tool is now free, and the institutional knowledge has been scraped, synthesized, and encoded into an open-weight model available to anyone on Earth with a smartphone, what is the Western worker's unique value proposition?
It's a chilling question. If your entire career is based on synthesizing information and a free model does it instantly, your geographic and educational premium is just gone.
So this leads to a massive political question. Let's play this out over the next election cycle or two.
Okay.
If we don't see broad prosperity from AI in the next, say, 3 to 7 years, if the middle class just sees their wages compressed, their energy bills go up to power data centers, while a few tech stocks soar to $10 trillion valuations, do we see a grinding, unstoppable democratic pushback?
That is the social feedback loop, and it is a massive vulnerability for the Western AI model. In democratic societies, you simply cannot sustain massive public subsidies, favorable zoning regulations, and cheap energy contracts for an industry that the voting base perceives as actively impoverishing them.
They will vote against it.
You will see a legitimacy crisis for the entire AI project.
We're talking heavy taxation.
Taxation, certainly, but also aggressive antitrust actions. Politicians running on populist platforms to break up the hyperscalers. You will see AI pause movements, which currently exist mostly on the academic fringes, move directly into mainstream political platforms.
It becomes a wedge issue.
The democratic feedback loop becomes a massive, tangible drag on continued investment. The permits for new data centers will get denied at the local level by angry city councils. The energy subsidies will get revoked at the federal level.
And we have to contrast this with the East's model, because their feedback loops are fundamentally different.
This is a crucial structural difference. The East, utilizing state-guided capital, does not face those same immediate, volatile democratic feedback loops.
They don't have town halls shouting down data centers.
No. They can absorb longer payback periods. They can tolerate lower financial returns on infrastructure if it serves a national goal. They can direct the deployment of AI to specific industrial sectors without having to wait for consumer adoption curves.
And crucially, they don't have to worry about a populist backlash at the ballot box next November.
They can simply wait out the turbulence.
Which gives them a massive structural advantage in a long-term technology race.
Right.
But, and this is a big bus, but that assumes the race is still a sprint and that everyone actually agrees on where the finish line is.
Right.
Let's look at the geopolitical narrative that is driving all of this. Let's talk about deflating the Sputnik premium.
If we connect everything we've talked about to the bigger macro-political picture, we have to look at why the West is spending so freely right now.
The underlying motivation.
Right. A significant portion of this massive capital pile is sustained by a narrative of civilizational competition. It is the ultimate geopolitical justification.
It's the new space race.
Exactly. The narrative pushed in Washington and Brussels is, if we don't lead in AI, they will lead. And the rules of the 21st century, the military dominance, the economic supremacy will all be written without us.
That fear justifies basically everything.
It justifies the CAPS Act, handing billions in subsidies to semiconductor manufacturers. It justifies fast-tracking environmental permits for energy grids, and it justifies extreme export controls on GPUs. It is public money and public will backing private bets, driven entirely by strategic anxiety.
But how do you embargo mathematics?
That is the fatal flaw in the entire geopolitical strategy.
Think about the mechanics of this.
Yeah.
You can slap an export control on a physical piece of silicon, right?
Sure, you can track hardware.
You can use the Navy to stop a cargo ship carrying NVIDIA H100s from docking at a port.
Yeah.
You can sanction a factory, but you cannot sanction an open-weight model that has been uploaded to GitHub.
No, it's impossible.
Once it's online, it is downloaded 10 million times by developers in every country on Earth in a matter of hours. The knowledge is out there. The weights are out there. The math is free.
And this is exactly where the Sputnik premium deflates. If the public, and more importantly, the policymakers who control the purse strings, realize that this existential race is largely a myth because the East's free models are perfectly good and the technology is inevitably diffusing globally regardless of how many physical chips we hoard, what happens to the political will?
The will to subsidize this massive capital pile completely vanishes.
It goes to zero.
If the voters and the senators look around and say, wait a minute, why are we giving billions in tax breaks to a data center that is driving up our local utility bills and compressing our wages just to win a race that can't actually be won because the math is open source?
Yeah.
The regulatory and fiscal environment tightens overnight.
And it tightens at the exact moment the financial reckoning that causally stacked house of cards we discussed earlier is arriving.
It all hits at once.
The adoption revenue misses targets, the CapEx gets cut by the hyperscalers, the data centers lose their premium pricing, the middle class revolts against the wage compression, and the geopolitical subsidies vanish.
It's a perfect storm.
The system starts to collapse inward on multiple fronts simultaneously.
Wow. We have pulled on a lot of threads today.
It's a dense...
We've looked at the sunk costs of the hyperscalers, the algorithmic innovations driving commoditization, the financial house of cards reliant on API tolls, the immovable physical infrastructure and grid strain, the labor compression for the middle class, and the deflation of the geopolitical space race narrative.
It's a lot to take in.
It is. Now, we need to pull all of these threads together into the final meta-narrative. We need to look at the deepest irony of this entire situation and how the initial conditions actually created the very threats we are seeing today.
The irony here is profound, and it is a classic historical example of how constraints can drive innovation.
Let's talk about the export controls.
Right. The West implemented those severe export controls on advanced GPUs specifically to slow the East down. The entire goal was to starve their AI labs of the raw compute necessary to train frontier models.
The logic was, if they don't have the H100s, they can't build the brain.
But it completely backfired, had the exact opposite effect.
It did, because they couldn't just brute force the training process by stringing together 100,000 top-tier GPUs in a massive desert warehouse. The Chinese labs and researchers working with constrained budgets everywhere were forced to get incredibly clever.
They had to be.
They couldn't rely on scale, so they had to rely on architecture. They had to innovate on the training methodologies. They had to become ruthlessly efficient with their data curation. And they had to master inference optimization, making the models run incredibly fast on older, less capable hardware.
Constraint-bred creativity.
It's like a sports team that doesn't have a massive payroll to buy superstar players, so they are forced to invent a completely new, highly efficient offensive system that changes the game entirely.
Exactly. And meanwhile, look at the West. The West was swimming in capital. The hyperscalers had unfettered access to mountains of top-tier chips.
Endless resources.
And what did that abundance breed?
Complacency. I mean, why spend 6 months optimizing your algorithmic training run to save compute when you can just throw another $1 billion at NVIDIA and buy more GPUs?
It's the easy way out.
Why innovate on the intricate grammar of the architecture when you can just scale up the size of the model and brute force the intelligence by memorizing the whole dictionary? The massive capital pile paradoxically removed the pressure to be efficient.
The West optimized for scale because they could afford to.
Yeah.
The East, forced by severe constraints, optimized for efficiency.
And as we discussed with the good enough threshold, efficient and cheap is exactly what 90% of the actual global economy wants.
The constraint bred the competition that is now eating the market from below.
So what does this all mean? We've explored all these pressure points. Where does this leave us? The sources outline a scenario for the future that they call the long autumn.
Right, because it's crucial to understand that despite all these vulnerabilities we've mapped out, this analysis isn't predicting a sudden, catastrophic AI winter.
The sky isn't falling.
No. We aren't going to see a scenario where the technology is just abandoned, everyone goes bankrupt overnight, and we stop using AI entirely.
We aren't going back to the Stone Age. The AI actually works. It is genuinely useful.
It works beautifully. But a long autumn is a slow, grinding compression of expectations over a 5 to 10-year horizon.
So the hype deflates slowly.
Exactly. It means the hype finally meets gravity. Capital expenditures get rationalized, meaning hyperscalers significantly drop their hardware spending to match actual revenues. Valuations slowly drift down as reality sets in and the massive multiples contract.
And the returns.
The returns on these massive infrastructure investments don't hit the promised 25 to 30% venture capital style returns. Instead, they hover around a very mundane 6 to 8%.
Like a utility company.
Yeah.
We built the power lines, and now they just collect a small, highly regulated toll.
Precisely. The grand narratives about achieving artificial general intelligence, or AGI, by 2030 quietly get footnoted, redefined, and pushed back.
The goalposts move.
Yeah. AI doesn't become a magic wand that solves all human problems and prints infinite money. It becomes like the internet in the early 2000s.
Which was huge, but took a while.
Right. Genuinely useful, providing broad, distributed productivity improvements across various sectors, but taking 20 years to fully restructure the economy rather than transforming the world in a single financial quarter like the investors wanted.
I look at the West's massive capital pile in this long autumn scenario, and the best analogy I can think of is that it's like an incredibly expensive education.
That's a good way to frame it.
The West basically paid the massive tuition fee for humanity to figure out how this technology works at scale. The tracks got laid, the fiber got buried, the data centers were built, the power grids were expanded, and they are genuinely useful for the world. But the shareholders who bought in at the absolute peak, expecting a permanent high-margin monopoly on intelligence, they lose.
They bear the cost of the education. They subsidize the learning curve for everyone else on the planet.
And who reaps the reward? The real value in this long autumn scenario isn't captured by the companies who spent $80 billion building the majestic cathedral.
No, it's not.
It's captured by millions of small, agile actors. It's the developer in Jakarta, the logistics startup in Lagos, the design agency in Sao Paulo. They are building entirely new, highly specific, incredibly useful applications on top of free, efficient, open-weight models.
Utilizing the tools that were given away.
They're paying absolutely nothing to the Western builders of the infrastructure, but they're capturing the actual economic utility of the technology.
The value shifts entirely from the infrastructure layer, the hardware and the foundational models, to the application and utilization layer, globally dispersed.
Which brings us back to the core premise of our deep dive today. We promised you an open exploration, and I hope we've delivered on that. We haven't solved the AI economic puzzle today. Nobody has the definitive answer, but we now have a highly detailed map of the pressure points.
We know exactly where to look now.
Yeah.
We know to watch the hyperscaler CapEx guidance on their next earnings calls. We know to monitor the capability of the latest open-weight models and see how closely they track the expensive proprietary ones.
We know to watch the local political fights over data center zoning and energy grids.
Right.
We know that whether this massive, causally stacked system cracks depends on a race. Can the actual realized enterprise revenue outrun the massive depreciation schedule of the physical infrastructure?
And can our democratic political systems handle an outcome where AI is just, it's useful but not transcendent after the public was promised a utopian prosperity dividend? It is going to be a fascinating and probably turbulent few years watching the numbers come in and seeing if reality matches the hype. And I want to leave you with one final thought, something we haven't explicitly discussed, but that builds directly on everything we've explored today.
Let's hear it.
If the true economic value of this massive AI infrastructure build-out ends up being captured by small, agile businesses in the global south, utilizing free, open-weight models, what does that mean for the geographic center of economic power in the mid-21st century?
Oh, wow.
Are the Western tech giants, driven entirely by competitive fear and overflowing with capital, inadvertently funding the greatest wealth transfer in human history?
That is a staggering thought to end on. A trillion-dollar accident that shifts the entire global balance of power. Thank you so much for joining us on this deep dive. Keep questioning the narratives you see in the tech space, keep looking for the structural forces beneath the hype, and we will see you next time.